crisis, and many of you may recall back in 2008, 2009, is that there were allegations of manipulation. So what effectively happened is you had some bad actors who were artificially adjusting LIBOR either high or low to effectively adjust their books at day end, right? It was all about P&L. As I'm sure you can appreciate, the regulators have a big issue with one or two bad actors being able to manipulate a $400 trillion market. There were billions of dollars in fines, and the regulators sought to fix LIBOR. So first, they reinforced the governance and the methodology behind LIBOR. How can we fix this structural issue? They spent many months fixing and solving for LIBOR, but at its core, they weren't able to solve for the fact that this interbank lending market no longer exists. So in 2017, the regulator of LIBOR, which is in the UK, so the Financial Conduct Authority, announced that it would effectively be able to deem LIBOR non-representative. They forecasted that because LIBOR can't be fixed, it's not based on real transactions, that the market should generally migrate away from LIBOR. At the same time, you had panel banks, and I think we can all understand why, sitting back and saying, okay, there aren't real trades for me to base my rate on, and two, why would I subject myself from further allegations of manipulation? So panel banks had started talking about withdrawing from the process. So the UK Financial Conduct Authority said, hold on, we can't wake up tomorrow and have no LIBOR. So let's start mapping out an effective transition. So first, Andrew Bailey of the FCA brought all of the panel banks to the table and said, let's come to an arrangement. And they concluded that panel banks would continue to submit LIBOR through the end of 2021. But after 2021, the FCA would not compel them to do so. So when we talk about LIBOR transition, there isn't necessarily a specific date that's carved in stone. The way we refer to it is after 2021, there's no guarantee that anyone will submit LIBOR quotes. So effectively, the regulators have guided us as a market that we need to be transitioned before the end of 2021. There have been some news articles lately that suggest we might get clarity around that quote-unquote end date towards the end of this year, but it's not a guarantee. That said, we're progressing forward to find alternatives and migrate the US market and the other jurisdictions away from LIBOR. In the US market, Mary Lou referenced the Alternative Reference Rates Committee. There are a lot of acronyms here, but we refer to it as the ARRC. And the ARRC was convened by the New York Fed, and it's comprised of about 50 different entities. Wells Fargo is a member, as well as other banks, insurance companies, trade associations. It's really designed to represent the broader US market. I want to say about 1/3 are banks and the rest are non-financial institutions. The design there, particularly with the trades, is to ensure that the broader market has representation. So you might have LSTA for loan syndications or SFA for securitization, where it's one entity at the table. However, their membership comprises multiple hundreds, if not thousands, of entities. So that's the backdrop for who is part of the decision-making body, or at least the entity that is making recommendations to the market. It's not just those 50 entities. There are dozens of working groups that are focused on specific aspects of the transition. And what they're doing is focusing on, again, subject matter expertise. So while the ARRC has 50 members, the broader working group body comprises, I think it's up to, over 200 different entities. So again, this isn't one person making a decision. This is a broad representation of the market. So in 2017, the ARRC identified its replacement rate. It evaluated over several years multiple options. And you can see on the slide in front of you, to me, this is the single best illustration of why the ARRC recommended the secured overnight financing rate, which is also known as SOFR. And effectively, we have to remember the issue with LIBOR, and you can see it third from the right, and it barely makes the screen. It's estimated that 3-month LIBOR, which is the most robust tenor of LIBOR, if you're lucky, you might see 500 million in average daily trades. Now, we saw earlier this year, it's estimated that there were probably closer to 0 trades during the market dislocation. And so, as again, a $400 trillion market, that's a cause for concern. So when the ARRC was evaluating the rate to select in lieu of US dollar LIBOR, it evaluated T-bills, effective Fed funds, the overnight bank funding rate. And what it found is they really wanted a more robust rate, a deeper market, because we're going to see changes in any rate throughout history. If the market has a dislocation, we want the rate that we select to still continue to be robust. So that's where SOFR came around. And as you can see from this chart, this one actually shows 850, I think, billion average daily trades. In fact, over the past year, it's exceeded 1 trillion in average daily trades. And the reason for that is SOFR is effectively the US Treasury repo market. So it's an overnight market in which entities post US Treasuries as collateral and borrow cash. So it's a fully collateralized borrowing market. It is the deepest, most liquid borrowing market we have in the US. So the ARRC identified that subset of the repo market and focused specifically on secured trades. And the idea being that when you have a flight to quality, you'll see people continue to transact in something that is fully secured, particularly fully secured with treasuries. And as you can see here on this chart, it is by far the deepest market in terms of average daily volume. However, that is a very different rate from LIBOR. As you can see on this chart, and I'm sure you're aware of, so LIBOR is what we call an unsecured rate. It's based on an uncollateralized rate. So that right there, SOFR being secured, LIBOR being unsecured, is a very fundamental difference. LIBOR, you have multiple tenors. Many of you probably borrow in 1-month LIBOR, maybe you borrow in 3-month LIBOR, but there are 7 different tenors of LIBOR, and they're all forward-looking. So you borrow on day 1, and you know your rate for that term. Right now, we only have SOFR available in an overnight rate. Now, the ARRC and the broader market would like to have a forward-looking term rate similar to what we have with LIBOR. The challenge is that in order to derive such a forward-looking term rate and still be compliant with some of the international reforms that were made after the financial crisis, the key is that it has to be based in objective and transparent transactions. So in order to derive a term rate, we need enough activity in overnight SOFR lending. And we're not quite there yet, but the ARRC forecasts that we will have a term SOFR available around this time next year. But currently, it's only available in overnight. LIBOR, inherent in that secured, unsecured aspect, has a bank credit premium. SOFR does not. LIBOR is a subjective methodology. While its waterfall prioritizes real transactions in the interbank lending market, the reality is that market doesn't really exist today. SOFR, by contrast, is an objective volume-weighted median of specific types of US Treasury repos. It's through Bank of New York Mellon, DTC. It's very objective and transparent. It's administered by the Federal Bank of New York. All of the data, including the volume and the rates, are available on the New York Fed's website. And LIBOR is administered by a private company, ICE Benchmark Administration. And lastly, back to the volumes. I would call 500 million in average daily trades for LIBOR probably a generous characterization, but SOFR, by contrast, exceeds 1 trillion in average daily trades. As we can think through the differences, the qualitative differences, there is a quantitative aspect. So this chart shows a time period of SOFR versus LIBOR. And what you can see is there are three different lines. So let me explain what they are. Your red line is your 1 month LIBOR. And then the light blue line is daily SOFR. So every day we have a new rate for SOFR. But the expectation is that similar to current loan conventions where you pay on a monthly basis or you pay on a quarterly basis, it's expected that we will also use SOFR on an average basis. So for example, instead of getting an interest accrual invoice where you have 30 rates for a 30-day period, what you'll likely see is an average of the prior 30 days. So that's what the darker blue line does, is it shows you, it illustrates an average, a 30-day average of SOFR. And why that's important. We expect that the SOFR market, and we've already seen it in certain products, is going to use an average, which smooths out some of the volatility. Some of the critique of using SOFR as a benchmark rate for the loan market has been that inherent in the repo market, there is some volatility, specifically at quarter end and year end. And you can see on the chart, right about September of last year, there was a really significant spike in the repo market. And that was a result of some dislocations in the repo market. You had a lot of settlements in treasuries, you had a new auction, you had tax time, and effectively you didn't have the right match in supply and demand. You have a lot of reserves that are set aside for capital purposes, and a lot of entities weren't able to deploy capital. So repo rates, just broad repo rates, spiked to 10% on an overnight basis, which is pretty wild. Now, that was only a couple-day period, and SOFR spiked to 5.25, but it definitely made some people step back and say, well, is this rate really appropriate for the broader loan market? What I can tell you is the Fed has stepped in and provided liquidity and continue to provide liquidity through this year. But that, 5.25 spike only translates into about what is it? I think it was 3 basis points over a 90-day period. And the comparison is that LIBOR actually increased by 4 basis points over that same period of time. So while it may look shocking, in effect, its effect is pretty de minimis because, again, when you're averaging rates, averages do what they're designed to do, and they smooth out that volatility. Another thing about this chart, this illustrates SOFR from 2014 to current. Well, SOFR was first published in 2018, so you might ask, well, how do we have rates before SOFR was actually published? And the answer is that because it's a data set that has been available to the market and to the Fed for a long time, what the Fed did is they pulled the same data set from, again, Bank of New York Mellon, DTC, and they backdated what SOFR would have been had they begun publishing the rate in 2014. The Fed further published some backdated information going back all the way to 1998, and that is available on their website. Now, I'd like to focus a little bit on what happened this year, because we also saw a big divergence between LIBOR and SOFR. That was different than the spike we saw in September. So earlier this year, as COVID really reared and increased its exposure in the United States, we saw the market react. And what you can see here very clearly is that as the Fed cut rates, we saw Fed funds decrease, we saw SOFR decrease, and we saw LIBOR increase. And in fact, the difference between 3-month LIBOR and SOFR well exceeded 1% for quite a period of time. Now, what's interesting is there are many different interpretations of what this means. So as a borrower, I think that the preference would be for something that moves with the Fed rates, right? You would want something that is lower rather than something that spikes during a market dislocation. The regulators saw this chart, and we've heard from the FCA, we've heard from the Fed, that they view this as an illustration that further supports the move away from LIBOR. They see this as LIBOR just did what it did. There's really no basis for why it did. Some can argue it was a flight to quality, and that's why we saw SOFR declining. But the reality is LIBOR moved in a way that was inconsistent with the rest of the market, fundamentally because it's an unsecured rate. No one's going to borrow and lend on an unsecured basis without a premium attached to it. And so that's what we saw here. So effectively, since the global crisis, while those rates have come back together, this spike, this divergence to many of the kind of the regulatory institutions or authorities, they view this as further support of the transition away from LIBOR. And what's interesting to note as well, there have been many questions that given the severity of COVID, does this actually delay the LIBOR transition? And what's interesting is some of the large regulatory bodies, there's one called the FSB, Financial Stability Board, which is essentially a supranational regulatory body. So, you know, the Fed is a participant, the Bank of England is, you have either central banks or regulatory bodies that are part of the FSB. And they reprioritized for 2020 based on COVID. And they kept LIBOR transition as one of 6 items that they felt were most important for the global market to focus on. So the $400 trillion question of is LIBOR transition delayed? The answer is no. The regulators have made it very clear that despite the turmoil and the challenges that we're faced with related to COVID, the transition is progressing and still has a target date of end 2021. Now, SOFR was a rate that was first published in 2018. LIBOR, by contrast, has had well over 30 years to become the $400 trillion market. So what we're asking SOFR to do is to ramp up to that $200 trillion level in quite a small period of time. That said, we have seen a significant pickup in activity. We've seen about 20 trillion in notional issued to SOFR. So those are your floating rate notes. Those are your derivatives, your futures. And in the derivatives market, options began trading earlier this year. This probably isn't the level that we need in order to derive a forward-looking term SOFR, but this activity continues to increase. And there are several milestones that are coming up this year in which we think it will really be the trigger to kind of launch more activity in SOFR. I'll get into that a little bit later. So Michelle, next polling question over to you.
Select the option that best describes you. Please be sure to make your selections and press submit to ensure that your answers are recorded for CPE credits. Your selections will be made within the slide deck, and don't forget to submit any questions through the Q&A box. I'm going to give you about 10 seconds left to make your responses, and we'll move to the results. And here are our results.
Great. So the results are about 24% feel that your company is well prepared to manage this transition. 48% have said we're not quite there yet. And 28% have viewed us as none of the above. So maybe perhaps you haven't begun or it's not relevant for you. So this next slide actually will be helpful for those who have not yet begun. I'm not going to cover all of these aspects. I would encourage you to read it and or check out the New York Fed's ARRC website about this. But part of the challenge in this transition is getting everyone educated and getting everyone prepared for the transition. So the ARRC released a checklist to identify specific areas to help each firm transition and prepare for no LIBOR. And the ones I call out are essentially identifying an individual or a group that can run point on LIBOR transition, stay apprised of the information that's coming in. One of the frustrations, which I can appreciate, is that we don't have all of the information. We're still trying to figure it out as a market. So we don't have all the answers now. There is a lot of information that comes through. Having someone in your organization be aware, be on point to share anything relevant is good practice. And then the other thing that I think is most important is really assessing your contracts and your LIBOR exposure. What contracts do you have that are tied to LIBOR? And are those contracts robust enough to survive a LIBOR cessation? And what do I mean by that? I'll get into it in just a moment, but do they have good fallback language? And if not, are there changes that you should be making? Is it just your LIBOR contracts? Do you have a LIBOR swap? Is LIBOR a default rate in one of your contracts? And does that need to be amended? So it's really doing the due diligence to explore where your LIBOR exposure is. Many of you, it may just be in your contracts, but if you're a large institution like Wells Fargo, for example, it's in everything from systems, models. It pretty much affects every part of our company. Now, I don't expect that to be the same for many of you, but just understand where your exposure lies and be prepared to address what happens upon these changes. Do you have any accounting or reporting issues or anything that gets triggered if you change your rate? Those are the types of things that you should do your due diligence on and get an understanding of where you are situated with respect to the end of 2021 target date. Michelle, I think we have another polling question.
What topics would you like to learn more about? Please be sure to make your selections and press submit. I'm going to give you about 10 seconds left to respond, and we'll move to the results.
And part of this is that, as I mentioned, there are many different components of LIBOR transition, and there's a lot of education that needs to happen. Primarily, the reason is because SOFR is a brand new rate, so we need to understand as a market what it is, how it behaves, how that may impact a loan based on SOFR, for example. So different aspects of this, whether it's swaps, whether it's an international multi-currency facility, those are areas that really we can dig in and help you understand the impacts.
And here are our results.
I don't see the results quite yet, but once they come up, again, this will help guide us for future conversations, and I can certainly address some of the questions here. Oh, I need to refresh my screen, so let me do that. .38% are interested in swaps, which makes sense. A lot of the exposures are very much tied to loans. Many people try hedge their exposure. We have 10% that is interested in international rates, almost 30% in market dynamics, and 25% in operational readiness. And can help you with your broader operational readiness. And this is fallback language. So what is fallback language? Fallback language is the part of your contract in which it explains what happens when LIBOR is unavailable. If you look, it's typically in your LIBOR definition, but and again, excuse me, some technical issues here. So when you look at your LIBOR definition, for example, oftentimes you'll have some provision that says if LIBOR is unavailable, you do this. Now, the do this differs by contract. And originally, a lot of the legacy contracts, there was never the idea that LIBOR would be permanently unavailable. It was always the idea that if LIBOR was for some reason unavailable on a temporary basis, that it would go to this other rate, and then when LIBOR became available, it would come back. So oftentimes you'll see kind of the range. I like to bring up floating rate notes because it's a really good illustration of unintended consequences. But in floating rate notes, oftentimes you'll see, we'll just use last published LIBOR if it's not available. Well, if you use last published LIBOR and it goes away permanently, you now have a fixed rate asset. Derivatives, for example, uses a quotation process. So if LIBOR is unavailable, your counterparty or your calculation agent will call up banks in London, ask what LIBOR would have been. If they don't answer, they'll call up banks in New York and ask what LIBOR would have been. The broad expectation is that no one will provide a bid for LIBOR when it's no longer available. So that brings me to fallback language. So ISDA for derivatives and for scope, derivatives comprise about 95% of the total exposure for LIBOR. ISDA has been working diligently to finalize their fallback language, which would replace the language in the master ISDA definitions. The ARRC has published fallback language for multiple products. They released those last year. And essentially what they do is they focus on 3 components. Your trigger event, so define the circumstances under which references to LIBOR should be replaced. Be very clear about what those triggers are. Second is replacement language and the replacement rate. Identify what the rate will go to. And lastly, the spread adjustment. Is there a spread adjustment that is required to be made? Which again, the goal of fallback language is to get you back to where you started. So derivatives and loans don't necessarily match up exactly. And for those who have hedges, it's very important to consider alignment of product. So we expect ISDA to release their final definitions pretty much any day now. It could be by the end of this month, or it could be beginning of August. And what we expect their language to say is that upon a public announcement that LIBOR will cease to exist, so that public announcement will be either by the administrator of LIBOR or the regulator of LIBOR, so the FCA or ICE benchmark. If they issue a public announcement that LIBOR is to be permanently ended, that would be a trigger event. Or if the Financial Conduct Authority, the regulator of LIBOR, they have the powers to deem LIBOR unrepresentative. If they do that, that's considered to be a trigger. Now, what does it mean to be unrepresentative? This really is around the idea that, you know, after 2021, if we have, let's say, 2 panel banks that are submitting LIBOR, LIBOR technically will exist, but is it something that we should base our trades on? And the FCA has essentially suggested that no, it's very likely that they will just say LIBOR is unrepresentative and no one should use it. So that's what that pre-cessation trigger is. It means LIBOR is still technically around, but it may not really be worth using. And then the third trigger, which only exists in loans in the US market, is this concept of an early opt-in election. You'll see this frequently in syndicated loans. And the idea being that if and when the SOFR loan market is more robust, someone who has a LIBOR contract can just opt in to a SOFR rate well in advance of a LIBOR transition or a LIBOR cessation. Now, notably, that is not the case in derivatives, and it's only the case for loans. So right there you have some differentiation. And then in terms of the actual rate that's used, this is where we see the biggest divergence between the loan or the cash market, so your loans, your bonds, and your derivatives market. ISDA has been very clear that a rate, let's just use 1-month LIBOR as an example. 1-month LIBOR upon a trigger will go to a 1-month compounded SOFR in arrears plus a spread. That spread will be based on a 5-year look back, and it'll be the median between 1-month compounded SOFR and 1-month LIBOR. Right now, that's about 10 basis points. So you would go effectively from 1-month LIBOR to 1-month compounded SOFR plus 10. that would be the replacement from the LIBOR component. Now, again, those are rough numbers. The calculation for the spread will not be made until a trigger occurs. Bloomberg will be publishing those spreads, and again, that will be a very transparent process to the market. Now, the ARRC on the loan side, loans prefer their term structure. They really like it. So they've opted to use a waterfall approach. So they will do, upon a trigger, the first step in the waterfall is typically a term SOFR. If term is available, then you would have kind of more similar, you'd have a forward-looking term rate based on SOFR instead of LIBOR. Now, if term is not available, you would go to the second step in the waterfall, which would be a compounded SOFR. So that would align more with derivatives. And then each product has their next step, so it does differ by product, syndicated loans versus a bilateral loan versus a floating rate note. So I would encourage you to pull the actual language off of the ARRC's website. But this is a summary where effectively you have a waterfall approach. That's called your hardwired language. So it's hardwiring a rate into the documents. Upon a trigger, there's really nothing you have to do. It's already in the documents. The second approach is an amendment approach. And we have seen this kind of used in the beginning. We're seeing a switch as the ARRC is really encouraging the market to use a hardwired approach. And what we're seeing, and so what the amendment approach does, it says, if LIBOR goes away, we'll effectively come back to the table and recommend a rate replacement. It will likely be what the ARRC recommends, but it does require the parties to come back to the table. So I think understandably so, when we don't have all of the information at hand, people have liked this idea of having control down the road. However, when we look at the market, we have hundreds of thousands of contracts. And if they all use the amendment approach, I would suggest that it might not even be operationally feasible to re-amend all of them down the road. So that's where the ARRC has come out and said we really strongly encourage the use of hardwired language because at least it prescribes the rate. And oftentimes, you know, on the loan side, you can come back to your bank pretty much any time to explore other pricing. So the expectation is that when SOFR loans are available, you know, maybe that's what you do. Fallback language is designed to be a security belt. It's a seat belt. It's there in case you need it. But the expectation is that once the SOFR loan market becomes more robust, we'll probably see people just exiting their LIBOR loans and going straight into a SOFR loan. Now, the difference being with derivatives, it's not quite as easy to terminate a swap and go into a new rate. There could be some cost implications. And so that's why for derivatives, this fallback language is very important. The expectation is that a protocol will be conducted, so entities can just sign up and opt in, and it will, by definition, adhere them to these new definitions for rate triggers. And then, again, this is kind of a more detailed expectation of some of the industry timelines for, you know, through the end of 2022. Or end of 2021. What I'd like to point out is that a lot of this discussion on fallback language and some of the other areas is really the result of the loan market not being ready today, right? We have not seen bilateral SOFR loans broadly issued, nor syndicated loans. And the loan market has a huge impact on the liquidity of SOFR itself. I think come the end of this year, we'll see much more activity in SOFR loans, which again will provide relief and will de-risk the market away from LIBOR. So you'll see that in some of the expectations, right? We expect SOFR floating rate note issuances to continue picking up. We expect to see some bilateral loans issued in SOFR at the end of this year, beginning of next year. And along with the ARRC's recommendations, we're going to start seeing no more new LIBOR products being issued. And then lastly, I'd like to touch on, before we get into our last poll and Q&A, This is really a snapshot of the global reform efforts. I mentioned that LIBOR exists in 5 primary currencies. Here you can see the results. Each currency has its own rate. So in the US, our working group is the ARRC, and we've identified SOFR as the replacement rate. For example, in the UK market, they've identified SONIA as their replacement rate. Now, different from SOFR, SONIA has been published since 1997. So it has a much longer history. Market participants have a greater understanding of the rate. So we've seen SONIA pick up quite significantly. Last I heard, it's about 50% sterling LIBOR versus SONIA in derivatives issuances, which is a really good fact pattern. Slowly, it will be more SONIA than LIBOR, for example. So each currency jurisdiction has their own approach, which is different, right? We're disaggregating all of the LIBOR methodologies and bringing it back to each currency jurisdiction. So with that, Michelle, let's go into our last poll.
Great. Please select the response that best describes your level of knowledge after viewing this webinar. Please be sure to make your selections and press submit. And don't forget to send any last-minute questions to the Q&A, as we'll be moving there shortly. I'm going to give you about 10 more seconds left to respond, and we'll move to the results.
Wow, even they get quizzed like children.
And here are our results.
Great, thank you. So it looks like 82% feel more informed, so I'll say thank you for that. I'm glad this was effective. 11% were already quite familiar with the topic, and 6% feel it was too technical. So that's great feedback for us, so thank you for that. And with that, let's jump right into Q&A. Colleen?
Great, thanks, Rudy. Yeah, we've got a few good ones coming in, and let's start with this one. When is the right time to start discussions on replacing LIBOR as an interest rate factor in credit agreements?
That's a great question. I would say yesterday would be a perfect time to start doing that. The reality is we've known as a market for a long time that LIBOR is going to cease to exist. Some people, it's like the spectrum of grief. Some people are still in denial that it's going to exist. I'm certainly, by factor of being in Wells Fargo's LIBOR transition office, I'm already at acceptance. But some people are in anger mode, or somewhere along the spectrum. But what I would say to you is that while we don't have all the answers now, it doesn't mean you can't ask questions to your bankers, and you should be informed about what your options are. I've seen some clients where they're very uncomfortable with the idea of uncertainty. And so they've opted to, go with a prime loan, for example. Now, that's not going to work for everyone, and it's certainly not the recommended approach for the entire market, but you have to do what makes sense for you. And I have some clients who are completely comfortable using fallback language and say, just let me know when I know my rate. So it really depends on your level of comfort, but these are conversations that you absolutely should be having with your banker. And we, have already incorporated more robust or ARRC endorsed fallback language into our loans. So again, I think that's a conversation that I would encourage you to have now.
Great. And we have another good one. Does the shift to SOFR mean that the Fed will be administering the benchmark? And how do you anticipate that impacting the validity of this rate at the global level?
That's interesting. So yes, the Fed is planning to continue administering the rate. And to me, I think that lends much greater credence versus a private entity. No one is going to, or I certainly hope, no one is going to think the Fed is going to engage in any manipulation. And so they're very clear about their methodology. They're very transparent.
Lies!
Is comprised, or how the rate is comprised. So I think that strengthens the support of SOFR worldwide. And what we've seen in each currency jurisdiction is that it is, in fact, their central banks or some of their primary regulators who are serving as administrator of the rates. And I think that is 100% a result of the manipulation that happened with the private company. If you bring it into the public domain, that's an area that you can protect and prevent manipulation.
Great. And there's another question here, and you may have already touched on this a little bit, but here it is. Is there a place where we can see the historical variance between the LIBOR rate and the SOFR rate? I would love to understand if it's been higher, lower, or not relevant.
Mm-hmm. Yeah, absolutely. So again, the New York Fed has published rates back to 2014, and then I want to say 1998 to 2014 is it's survey data. So they surveyed the repo market participants and the large dealers, but certainly 2014 to current, I think it is very valid data. It's effectively what SOFR would have been anyway, had SOFR been averaged at the time. And you can compare that to LIBOR. You can compare it to 1 month LIBOR. You can compare it to 3 month LIBOR, and there are differences. So on average, I want to say, I'm trying to remember what my averages are. I think my 5-year average right now is about 10 basis points for 1 month LIBOR versus SOFR. It's about 25, 26 basis points for 3 month LIBOR. So every tenor of LIBOR is going to have a different corresponding spread. But yeah, so historically SOFR has been on average lower. But you will see some periods of time like we saw in September where SOFR spiked above LIBOR. You'll also see that sometimes in the quarterly adjustments. It's been referred to as window dressing, but sometimes you'll see entities settle some of their lending right before reporting time. And that's why we see some supply and demand divergence around quarter end. That's kind of that window dressing. Those are the periods of time that come to mind in which SOFR was actually higher than LIBOR, but on average, LIBOR has been higher than SOFR.
Great. And I'll remind everyone, if you do want to submit any more questions, we're starting to run a little bit low. Rita, you spent quite a bit of time talking about derivatives in the contracts. And this question is about futures and options based on LIBOR. And the question is, what will happen to the derivative contracts, futures and options based on LIBOR? And just wanted to put that in front of you in case there's anything else you wanted to cover on that topic.
Sure, and it's a really good question. So broadly speaking, I think both ISDA and the ARRC have tried to solve for the majority in recognition that there are parts and aspects of the market that will need different solutions. So what do I mean by that? The lion's share of derivatives will be able to use fallback language. So that's where I described, let's say it's a, vanilla fixed pair swap where you're paying fixed, receiving LIBOR. It's that LIBOR receipt that upon adherence to the protocol, that would change to SOFR plus a spread. Now, in the options market, it's not as simple, right? You have, depending on your option, you have different strike prices. And so that is a component of the derivatives market that is still under discussion as to how best to amend those types of trades. So there isn't a great answer on that, except to say that it is now, once we address kind of the majority, those are the pockets that are up next in terms of determining what the right approach is. And likewise, we see that in the cash market side, where the majority of contracts can be amended or adjusted to incorporate fallback language. Some can't, whether that's because it's a floating rate note and it requires 100% bondholder consent. Same thing with the securitization, or maybe there's something like, in the muni market, for example, where it would be required to go back for legislative approval. I mean, depending, the underlying reason, there are parts of the cash market where, again, there needs to be a decision made or a process to amend those that are not easily amended.
Great. And this is actually the last question. and you may have already touched on this as well, is there any new clarity on how the adjustment to the spread on revolving credit agreements will be determined?
Yeah, so this goes back to what's actually in your contracts. So I can talk about what the ARRC language would do, but ultimately it's going to be entirely dependent on what your contracts say. So if your contract uses the amendment approach, it might say it's up to the lender. It might say it's up to the lender and borrower as well. Oftentimes in the amendment approach, for example, they may look to whatever the ARRC has recommended. So that's where the details do matter. But broadly speaking, if your contract uses ARRC endorsed hardwired language, upon a trigger, that's where it would go through the waterfall. Step 1, term SOFR if it's available plus that adjustment spread. Step 2, if term SOFR is not available, would be that average of SOFR plus a spread. So again, it will be highly dependent on what your contract language actually says. And that's why it's really important to do an assessment of your exposure and what your fallback language actually is. And the spread, one more thing, just to, I know this point is raised quite often. You know, why is there a spread adjustment? And the reason for that is the goal of these contracts through fallback language is to get you back to where you started. Now, the challenge is LIBOR and SOFR, it's apples and oranges. So how do you get both sides of the equation to match? And that's where this median adjustment spread comes in. It's designed to get you back. There's no guarantee it will be perfect. But certainly it's better than just having your contract go to litigation because it's unclear what the rate will be. So that's really the design behind fallback language. It's a safety belt. It's good to have in your contracts, and I would strongly encourage you to evaluate your contracts that you have currently. You know, the regulators, the Fed, the ARRC have very strongly encouraged the market to adopt these types of contractual language. So I think you'll see a big shift in that. We've already seen a lot of clients incorporate this type of language into their contracts. It's just good best practice in terms of de-risking away from LIBOR.
Great. And Reedy, that was the end of the Q&A.
Okay, great. Michelle, back to you. Thank you everyone for attending, and I hope this was helpful.
Thanks so much. This marks the end of our webinar. Thank you for joining us today. We look forward to you joining us on future webinars. You can find information about upcoming webinars in the resources widget. Don't forget to download your CPE certificate in the certification widget. Your CPE certificate will also be available to download in the thank you for attending email that will be sent within the next 24 hours. If you have any questions regarding CPE credits, please feel free to email conf@financialexecutives.org. Have a wonderful day. And again, thank you to our speaker for today's webinar.
Come back when you're broke. Dad? Daddy? Daddy's that you? All right, I don't think he's here.
What up? Lower? Did I just ruin it?
Just finished.
Oh, hell yeah. Someone said I'm being summoned in here?
Yeah, Tiger was looking for you.
Oh, then he left?
Yeah, he left.
Hell yeah, I love it. Yeah, she explained it pretty well. I mean, that's the first presentation I've seen where they actually talk about the repo by name.
So what's your like a summation on all that stuff? what's your summation on what she was saying? I don't know if you were listening to it all or not.
I mean, I've basically, it's just, for me, it's like confirming everything that I've read, basically. And this was a year ago that it was recorded. So, like, basically, everything she was saying basically happened. They weren't ready.
Yep.
You remember the polling? Most of them weren't ready. I mean, that was clear because, it was supposed to be over and done with by January. But, I think they're behind schedule.
Yeah.
And they just came out and said, last week that they're going to have to curb inflation at faster rates now.
Yeah, I saw that too.
So it's all coming
I think they were
together.
saying, 50 basis points, right? At least.
Yeah. So it's going to be volatile, I think, in certain areas.
Right? Didn't they say they were raising it June and July?
I think May, June, and July, right?
They have to, man. It's 8?
Oh my gosh.
Oh,
Dude, no
yeah,
one's
we're
gonna be
have
ready for it.
We are, fuck yeah. We're gonna
Well,
be
yeah,
ready.
we are, but I'm saying,
Yeah, I mean, I know what you mean. But bro, I mean, these people are there. They're saying that everyone's getting out of tech, and everyone's betting on a bear market. I'm like, that's what they fucking want, dude. Like, are you serious? Like, there's no reason other than headlines that you would want to do that.
That's kind of what I've been telling my family. It's like we weren't ready for fucking any of these other recessions that came out of nowhere. Like the fact that this is so obvious right now seems a little.
This is the first time, you can be ready for it because the data is available to look at.
Yeah,
Like,
wait, I'm bringing my thing.
Yes, they say one thing. Oh, is that your mom, dude? I'm sorry.
like, Mom, I'm trying to make
China's
money.
no good. Well, the people that made this bot that we just got, they're fucking GME apes, so it all makes sense. They got them all corralled on the fucking news headlines.
They're gonna be watching what data you pull. They're gonna be like, why is he not looking up anything to do with memes?
Well, I used their own bot in their server to show them what I was trying to say, and you know what I mean. And they didn't say anything, and they just were like, well, I'm not gonna invest in a Chinese company. I'm like, okay, well, what? That's literally your only argument? Not an argument, dude.
Well, they're thieves and they stole your money.
Who aren't thieves?
Um,
Everything we accuse other countries for, we've done pretty much.
You're like, hey, I need you, and you left.
Who, me? Oh, it looked like you were gone, so I went back into the chat.
No. I'm here.
What's this prediction I'm responsible for?
Rexer, bro.
Oh.
I'm gonna triple down on Monday.
Let me see.
Yeah, I don't know what I'm gonna do, but we'll see. What's up, bro?
It went down over a point. But yeah, that was the first half of the day for Rexer was kind of concerning. And then it pushed down towards the end of the day.
Appreciate it. That'll do it.
Stay up for pre-market. I just want to see what happens.
Oh fuck! I forgot. I have an eye appointment at 8:30.
I had to go to the gas station and talk to Sandeep. He was like, "All buddy, 2 for 1 today." But yeah, I don't know what I'm gonna do next week, bro. I think I'm just gonna sit and wait. But I say that every fucking weekend, and then I blow my load at Monday at like 8:30 in the morning. We'll see.
To get like a
Wait,
shock
is it
therapy
still sitting in
treatment,
waiting time?
I mean, I only have like 50. I'm only swinging like 15% of my account. You know what I mean? At a time, because I got the rest in China. So I just reserved, a percentage of my account to swing on the side to try to make more money for, the big kahuna.
Dude, the gap finally filled. Oh.
Dude, I know.
Wait, the lowest bottom gap one?
Yeah, it feels so real now.
Yeah.
Oh man, where have you been? I haven't heard your voice in forever.
My dad got in an accident. I had to deal with that.
Oh man, sorry to hear
Oh
that.
no, sorry to hear, man.
Yeah, he's better now. He's healed, but for a while it was concerning.
Yeah, that's good to hear.
Yeah. Damn. Well, you're about to be rich.
Wait. Is it the last lowest bottom gap?
Yeah.
So there's no other gaps
Hey,
below us now?
well, there is, but we're talking like all the way back to 2012, I think. And I think it's such a small gap, it doesn't matter for the Hang Seng Index. But for KC and all that shit, yeah, I think we're good to go. Like, it just
Okay.
cleared all that shit. Did GoTo fill its gap too?
Let me check.
Because
I
and
think
also
it should have by now. It's
Yeah,
almost
it
filled.
did.
I don't think GoTo did. I don't think
No, it
Case
did. It did.
It did?
Yeah.
It's close enough to a gap fill that I don't think it matters.
Yeah,
No,
I think
they're
there's a
like
certain
actually
threshold
filled.
where there's a threshold where I think it doesn't matter. But yeah, bro, when we're talking, the FTD data came out, and I confirmed. I looked at the bot, but then I confirmed the data too from the SEC, and yeah, KC's on historic FTDs right now.
Damn. Oh.
So is GoTo.
Hey, you guys know what to do, right? This is reminding me of AMC. If it hits $20, sell and buy on the retrace.
No shit, bro. We gotta play this one smart.
Yeah.
If we get like a 60 or like an 80 to 60% day, bro, like we need to sell at the fucking top, right?
Yeah.
Like at least a percentage. You know what I mean?
Yeah.
Like, you can't just hold that shit.
Yeah, I
You
agree.
can't just do it. You gotta do it.
Wait, is there a risk of delisting for DD? Because I got some money there.
I don't buy any of it until I see it happen and I lose all my money. I'm not gonna believe it. That's the scary part.
I don't know, because you mentioned red herrings. Like, I wasn't sure whether or not like you picked the right or wrong China. I wasn't sure.
Well, that's why I personally avoid DD, right? Because that could be the one example they make, but who knows? I pick the ones that you don't ever hear about, like KC and CD and Toy, like these really big upcoming like tech companies in China that are already partnered with like Microsoft and Steam and shit, Sony. And you're thinking they got to be a part of this metaverse, because you look at the metaverse, it's just data storage, right? Basically, all it is, peer-to-peer data. So, I don't know. I tried to carefully pick the ones that number one, made money. Number two, were trending up in revenue, and were specific sectors that were obviously beaten the fuck down, like consumer discretionary and technology. The fact that these motherfuckers were there to tell me that they're running away from technology right now, I'm like, dude, do you not see the fucking gaps everywhere? Like, what the fuck is wrong with you?
Yeah, they're prepping it.
Yeah, they're scaring you away from opportunity.
Yeah, everyone thinks the SPY's about to crash.
I think it's
Well,
going to
it's
trade
already
sideways
crashed.
for a while. It's going to trade sideways, I think.
I think the tech is going to weigh heavy on the next 2 weeks, and if tech earnings go
Yeah,
down,
it
the
will.
market will come down, and then we'll see from there. But I don't think it's going to do the complete COVID crash.
Fuck no.
Nah.
No. And if it does,
The COVID crash
I
was
mean,
fake.
if it does, let's just say it does. Let's just say for some fucking reason the SPY just shits itself. I mean, it's obviously got to affect other shit, which affects other shit.
Yeah.
So I mean, if the SPY tanks, it all depends what they're holding. They just loaded up with metaverse shit with the SPY.
And when you look, like Fidelity's first day of listing, did you see how fucking shitty they did? It's all by design because they're shorting. And they're gonna fucking cover at the bottom.
Yeah.
And that's gonna drive the shit up. It's gonna probably help drive the shit up on a major scale. And then I think they're weighted heavy in metaverse because it's gonna keep the SPY trading sideways and shit. It's gonna because remember the divergence. I mean, the MCHI's got to catch up. It has to catch that trend line. They have to trend each other. They always
Mhm.
have before now. And then you look what's going on in the world when they're not trending. All of a sudden, it's fucking chaotic. So they got to get back to normal. There's no way it's coincidence. Like the second the fucking MCH or MSCI and fucking SP 500 diverge, like all these narratives start coming out, and it lasts a year long, same amount of time. Inflation's record high.
Don't
No, no,
catch
no.
us.
Yeah.
And then you
Don't
see
catch
the
us in the
three.
middle of it.
Yeah,
That's
and you see
basically
the
what they're
three
saying.
least inflated countries, and they're fucking China, Japan, and fucking India. I mean, come on, dude. It's so fucking obvious.
How long do you think they're gonna continue delaying?
Till
I
they're
think they're
ready.
done. I think that what we saw last Friday with the spy was like the last like hoorah. That shit was nuts. I wish I would have played puts. They were up like 600%.
So I heard someone say like what September, August. I wasn't sure why though. They just kind of
I
said
think
it.
that's when the spy is going to continue going upwards and fucking close over 500 by the end of the year. But I think we're going to see a fucking slow and boring ass summer while these Chinese stocks go up, and everyone's like, "What the fuck?" You know what I mean?
Oh, you're
But they're
thinking
probably
like
gonna
June,
spike
July,
again.
maybe?
Yeah, I mean, I'm keeping my like the core logic here is I think it's going to work as long as we're over a trillion repo. But you're
Hmm.
gonna notice though, it's gonna be I guarantee you're gonna start seeing the our criteria. It's gonna get harder and harder and harder to find them when this repo starts coming down.
Hmm.
'Cause these gaps gotta fill. All these things are gonna be returned, and their haircuts are gonna be gone, and then their value is gonna go up because the haircuts are not there. And by
I mean,
definition,
I'm pretty sure
traded at
some
fair
of these
value.
stocks just have a gap we're looking for anyway. Like with the biotech sector, they're just filled with that shit.
Yeah, no, that's just the one I fucking hate is biotech because there's so many of them. There's like
Yeah.
3,000 tickers. And
Hmm.
you don't see any of health really in the like spine shit except for like major companies like J&J and shit like that. All these small companies, I think they're just like liquidity vehicles or something. They all have low floats. You know what I mean? I don't know. I try to stay away from health, even though right after I fucking sell for a loss, they run up like 80%.
Yeah, I know, right?
Every fucking time. I can't do it anymore. And, like, there's always that one dude
Yeah,
in
I,
the
I
group
think
who
that
still
comes
holds.
after.
Yeah, I think this obviously tech's obviously just tech and bit. I think crypto's going to run too with all this.
Oh yeah.
But everything's been in a down cycle, man. I mean, if you look at the RSI on the daily for the Dow, dude, I mean, that's the biggest RSI drop that the Dow has had. That was the COVID drop, bro. I think on Friday. I mean, we're talking that was a bad day.
Yeah. Those last
And
2
for the
days were
RSI.
really bad.
Yeah. That's why I played calls.
I'm wondering whether or not I made a mistake because I basically doubled down and leveraged up on Friday
Oh, I
on
think
all my
I
China.
think I know. I think if you bought calls Friday afternoon, you're smart as fuck. You're Monday because dude, you know this
That's what I did.
motherfucker is gonna violently rip to the upside. Like if it doesn't, I'll be shocked.
Like I'm not really concerned about the time frame. I'm pretty far out, but I'm just concerned. Is it gonna do it or is it gonna keep dropping? Because if I get IV
I
crushed, that's gonna hurt like hell.
well, that's what I'm saying. I think we're about to enter into IV crush season.
Oh fuck.
But I
Not
could be
sure what
wrong
to
though. I
play.
don't know. It all depends on the repo though. I don't know. I mean, when the shit starts coming out and the liquidity returns to the market, it's like it all depends on where they're going to put it. And
Yeah, because I
my
just remember what
assumption,
happened this time. Yeah, your assumption.
the difference last year is that last year I think was the can kick year. Like, well, everything traded sideways last year until the end of the year when they reset their fucking clock on their debt ceiling or whatever, and then they were able to go again. But we also had LIBOR and all that shit transitioning too last year, which is exactly what this is. It's LIBOR going to SOFR. SOFR is the repo.
Hey,
So they
quick
had to get
question:
up to a certain volume.
Is
Sorry,
the
go ahead.
Hang Seng basically the U.S. spy?
No, Hang Seng is like
No.
it's really tech weighted. I wouldn't say it's the SPY, but it's not as much tech weighted as SPY. It's mixed with like a lot of consumer shit too. But I mean, I'd say it's more like the Dow.
The Dow.
It's more like the Dow than
Okay.
the SPY.
I saw something weird because after the 3 red lines eased, look at the SPY and the Hang Seng on the daily.
Oh, I know it. Yeah. I know what you're saying. Wasn't that also like the case with Dow too, or no? Or am I mistaken?
No, I don't know. I'll have to check that out. But I was only
That was
looking at.
what day was that?
Oh shit!
I
I don't
forgot.
know because
It's
the Hang Seng was going down the night before, so I was like, shit. I wonder if SPY's is gonna go down.
well,
And
yeah,
I was
yeah.
looking at the chart, and I'm like, dude, it looks
Well, I
exactly
think
the
what you're
effing
seeing
same.
I think you're seeing a rebalancing of tech in the sectors, and they may be going, one to the other or something. Because I mean, tech is obviously the primary. People that are running away from tech, I'm like, it's obviously the primary focus right now for these institutions. Dude, they're like, the U.S. private equity is 36% weighted in tech, dude. That's fucking nuts.
That's so nuts. Oh my gosh.
Yeah. And the iShares MSCI or MCHI Emerging Markets Fund, dude, I mean, the PCR volume on it is ridiculous. I don't know if you saw the graph I sent earlier, but there's nothing else that even comes close in the entire fucking market. I showed it to that dude. He's like, puts. I'm like, no, you can look at this contrarian, you fuckhead. I can't believe
I
that. I
still need
mean,
to catch up.
goddamn, it's gonna. I don't know. He said that they're not like that. That China's not going to meet the gap requirements. I'm like, dude, then why are they fucking lending them as a tier 1 asset with AAA rating? It makes no sense, dude. Like this shit's verifiable in the documents on Sec Edgar that they print out. Like they're putting money in this shit for a reason. Like the Senate's got Alibaba. Like, are you fucking kidding me?
Yeah, I can't believe
They're-
that was number one.
Yeah, they're front running that hoe like a motherfucker, dude. Crazy shit.
I don't know why I just got a visual of Nancy Pelosi making that fly movement.
Oh god.
She rubbed her wrist together.
Don't. Hey, sorry if
I
this
mean,
question's been answered before, but I'm trying to just catch up. What's the metaverse thing right now?
so it's basically like metaverse is like, I think it's fucking retarded, but I think there's money to be made there.
VR chat.
Yeah, it's like we're gonna fucking have peer-to-peer data. We're gonna own nothing and be happy about it, because everything's gonna be digital. We're gonna like have digital prostitutes and shit. I swear to God, this is what they wrote this on their website. The Ball Metaverse ETF. They're like, yeah,
Right.
even prostitution's gonna be fucking possible. It's just this pipe dream where we're all living in this virtual world. But the whole point of this narrative, I think, is to get everyone thinking about data and everyone thinking about their own personal data, and they're about to start. That's how we're going to be seen and looked at from a governmental standpoint. Is we're going to be a set of data, and that's what all these new IoT fucking shit's all about. Internet of Things. It's like peer-to-peer data, basically, and the whole thing is they're going to sell you on like all this different shit about where you need to store it and shit like that. It's going to be basically institutions and companies competing for your data, I think, is what it's all about. Instead of it being a fucking like free for all where anyone can just steal it, they're gonna have to incentivize our data. Like we're gonna be incentivized to give a company our data, like Jasmine, for example. They're an example of a company that's going to be doing that. It's like a data protective service. Because that's what it's about. If you don't want your data getting breached in today's day in the world, that's the worst thing that could happen right now.
That's interesting. So, as far as the group and the core logic goes, then how are we exploiting it?
That's all. I mean, the core logic's all about the repo. When the repo's gone, I mean, I can tell you what's going to be viable there. But I expect it to be less and less opportunistic as time goes on. But the whole point is that it doesn't matter if we're in the two correct long-term plays after the short-term swing-ins. We've still played the game right.
Right.
Because I mean, I'm talking investment. I mean, these things are like investments, like especially China. Metaverse is more of like midterm, but China, man, I mean, We're talking like you're getting in at the bottom of their market opening for the first time.
Yeah.
So
That's
I mean,
crazy.
and they've
How
been
much
doing
time
it for a while. What's up?
What's the timeline for me to like load up on China shares?
Well, see, we started the group back in November last year, and we always predicted around April, right? I mean, literally, it's like this is almost dead on, like the time. It's a little bit delayed because for whatever reason, but
SFT.
yeah, they remember how they withdrew it and they reset the clock. Something may have happened where they weren't quite ready. There wasn't enough transition. They didn't have the volume in the repo they needed. And they got to get the volume to a certain point where they can start getting that forward-looking SOFR that lady was talking about.
So right
Which
now
is
it's
what
like now or never, pretty much.
Yeah, it's basically been like the international level of SOFR has been not active yet, and whenever that gets activated, it's going to free up all this inflation and put it in other places, I guess. My assumption is going to be Japan, China, and India. We've already seen the news narratives for it. And China's like, we will help India now. I'm like, yeah, sure you fucking will. And really, it's going to be the United
Please
States.
tell me this is the bottom, though.
Oh yeah,
This will hurt like hell if this is not the bottom.
The father of
No, it's the bottom.
Came out and said this that the bottom's here. This was like Friday, and like that wasn't shown on any major news network.
Because I went all in and I put in as much leverage as I could when I saw this. Because I remember the last time it hit this, like it got this low and it ripped to like double in like a week. This is the reason why I put everything in this.
Well, now you got to think. There's only gaps to the upside now to fill for these ADRs.
Do I get a loan? Do I get a loan and do more?
Fucking mortgage.
Yes.
I'm gonna sell my ASIC miners.
Trust me, I'm like all in on this shit too right now. This and Jasmine.
Dude, so what do you
my
think
concern
about
is just the IV crush.
Well, how long are your calls for? How far out?
3 months.
Oh, I mean, do you have any way to
right? Maybe.
Like, do you have any way to like?
Yeah, I could. I could just change him now. I could just change him
3
later.
months out. Hold on, because I only bought 2024 calls. Like I'm not fucking around with this shit. Like because I'm thinking long term. I'm like, all right, if I wanted shares, I can just get leaps. And I got shares already, so I'm like, I'm just gonna fucking load up on these January 2024 fucking options.
At the $2 strike.
My logic too. So
Yeah, the $2.5 strike. Yeah, that gives me plenty of intrinsic value.
Yeah, because I have some until September and October, but my closest expiry is 3 months.
Right.
I'm
Well,
just
my worry is
checking whether or not.
if they do can kick it, they're going to can kick it to October because that's when the fiscal year restarts.
Okay. Then I'll just
thing, but there's
move
no
it
guarantee
there.
that'll happen. Everyone's scared of everything we're in right now, which is exactly where I want to be.
Dude,
but maybe IV crush. I'm not sure. I kind of want to play this safe. I'm kind of hoping for October. Then I can get another loan. Please. I'm waiting on some big money right now.
Well, let's see. Let's see what Casey looks like for May.
I don't think Casey's closed the gap yet. Like their gap is like at $3, right? I think they still have like
It's at
another
$3.25. It's close. No, it's not a dollar. It's like 8%.
Look at the RSI though. I mean, this is where this is like where when I look at technicals, it's like the shit like this. Like when you're wondering like if it could go down, all I see is the RSI, and I'm like, dude, it's like at the fucking bottom on the weekly. KC's been oversold on the RSI on the weekly for like fucking for a long time since November basically of last year. So I mean, this shit.
Yeah, that's why I'm just betting on a bounce. Like I don't need it to bounce that hard. Just like 50%. All right, we're close. Then I close up, and then I under leverage again.
Well, you know, if this shit goes up enough, like this shit's gonna golden cross on the daily for the first time. It's never crossed before. Most of these ADRs have never ever crossed on the daily golden. So I'm just wondering, like,
Yeah,
what's the
that's why I bought those
ramifications?
calls 3 months out. I'm not
Yeah,
really planning
I
on
mean,
holding on those. Like,
the
I
I
just saw
mean,
the bounce last time it dropped this hard.
oh yeah. And really, I mean, if
I'm
you look
not
at what
sure,
happened,
right? But you mentioned
but if you
IV
look at
Rush.
what
I'm
happened
not
though,
sure.
did you see what happened though to the Nasdaq on Friday? And our stocks did not tank, bro. They did not. Like KC was the
Yeah,
only one that was red. They all finished green. I mean, that's what jacked me on Friday. Because I'm like, if this would have been the last time this happened, we would have been down like 20 fucking percent. But we weren't. We held
I
up.
know.
Everything did. And fucking CD finished 9% in the green on the same day the Nasdaq shit itself. I mean, talk
Wait,
about
is CD in the top 10?
CD. CD's my
Yeah.
number one pick for options. I mean, this motherfucker's a beast in options, dude.
Wait, so KC, go to Tal, DD, Dada, Tuya. Wait, no, Dada, Tuya, and CD?
Oh, I forgot to tell you, they just added Taiwan fucking semiconductors into the metaverse ETF. What the fuck, dude?
Wait, adding that now?
TSM is in the metaverse ETF. That's the semiconductors, Taiwan.
That
Like
only makes
this is
sense,
going
though.
down, bro.
I mean, they have a gap, I remember, but it's only half price. So,
Well, remember,
not
the
sure if it's worth
semiconductors
it.
is the big narrative, and the fact that the metaverse just loaded TSM, a Chinese ADR, and the fact that they're all sitting at the very bottom because as soon as they listed, all they've been doing is shorting them so they can cover at the bottom. Dude, this shit's
So are we
this
loading?
of metaverse.
Oh, TSM.
Yeah, I mean,
Like the
I'd
entire
pick my
ETF.
favorites, but if I would have known this earlier, I probably would have gone with TSM because now they got metaverse ETF exposure on top of, you know, the fucking buying in that's going to happen most likely, unless they're
Wait, is
using it as a short-term
TSM like
trading
with
game.
our core logic, or is it like, is this
Well,
going
China's not
along with
really.
China?
China's a separate ordeal. China's more deep value play. That's not doesn't really
Yeah.
fit the gap logic, but a lot of them do have gaps. But these are just these are so undervalued.
Yeah. I'm
I
just
mean,
not
the
sure
ones
about
I'm
TSM
introduced.
in particular.
Yeah, I mean, I don't have any TSM, but I'm just saying it's interesting that they have it in the metaverse. You know what I mean? That's just confirming a lot of shit that I think. But as far as my favorite picks, I like KC and GoTo, like for shares, more than anything else. And then for options, I like Toya, CD, and Data.
Oh
Those
yeah,
those
those tend to
those are
rip a
my
lot.
five that I'm worried about. Like I'm loading up on those five, and I got Jasmine. That's it. I'm not doing anything else. I'll swing with gap logic on this
KC,
one.
go to Tal, CD, Data, Tuya. Okay.
Yeah, I
Yeah,
went with
that's
one.
exactly what I've been doing.
Yeah, I dropped Tal for CD, and I'd rather have GoTo over Tal because they've been around
Is there
longer.
anything wrong with that? Because I thought the FTDs
No,
there, especially, no, nothing.
no,
Wait, so
no.
it's
I
still
mean,
all right to have Tal? Because I'm pretty like
yeah,
I've still got
I
some
think it's
money in
alright to have
Tal.
any of these. It's just my personal choice because I didn't want to have two educational stocks. I just want to have one, so I went with GoTo.
Wait, what's the sentiment on like the more big name stocks like
That's what I've avoided.
TSM and
Yeah,
Alibaba?
I've avoided all that.
Because
I've
like
avoided Didi, Baba, TSM. I haven't bought any of that shit.
yeah,
But
because I'm hearing okay, so they're like down and they like all-time highs are like triple the price where they are now. But then you look at like GoTo and you think, well, no, this can go like times 10, times 20.
yeah, and you look at the
So
revenue. But it's all they pick the biggest names though because they're picking the biggest revenue makers. So I think they're still viable plays. Just for me, I like the more quiet, not talked about plays. I feel like there's less risk, but I think it's all going to go up. I think all of it is, unless they're delisted, they're going up. All of them, they have to.
mm,
How can you tell if
How
a
do you,
company is going to be delisted or not?
you mean it's so rare. Usually, the only way it happens is if they do something illegal or if they fall under $1 for a certain amount of time, and they go to OTC. But just because it's China, that's all they're trying to say. Yeah, it's China,
Oh,
so it's going to be listed because of reasons. They don't give
oh, so
every
wait,
they're
right
have
like
to
there
just
any
full
do
of
been
shit.
like historical Chinese delistings? Like anything so far?
Not that I know of. I mean, I'm
I've heard
sure
of
there
like
are, but
two, but like nothing big.
Most,
Nothing
most
that they would talk
military.
about.
Yeah,
I mean,
most military.
I haven't heard of anything recently, but you know what I mean. I don't. I don't think we would have picked stocks that are going to get listed in the first place. These stocks are making money. There's no reason to be delisted unless
Case you go
they
to
did
Cal
something.
CD data too, yeah.
Yeah,
CD.
they're easily. I mean, I read it in filings all the time. They're easily regulated because they're highly liquid. And they're like the most highly liquid area in the market that no one's touching on, and as far as retail.
Wait, how long are we expecting IV Crush season? Maybe I can just game
I'm
this
thinking
with my
IV Crush
options.
is gonna happen
Move
for like
expiry out a
SPY
little.
and shit. You know what I mean? I think it's gonna happen for the SPY and energy and shit like that. That's way the fuck overbought.
Well, I mean for China, because I'm waiting for that rip.
I
You
don't
remember
think
when
we're
it
gonna
dropped
see
like a
IV
rock?
Crush in China. No, they don't have enough time for that. They've already dropped the IV to where it's in that mid range where it's kind of high, kind of low. They'll just run it up from here, and then it will be high. And then we
Wait,
can
so
sell call.
do I hold my calls or do I just like
I mean, I don't know.
extend them out expiry or like double down, triple
I don't
down?
think I can make that call for you.
Come
It's like
on.
a personal thing.
If it drops a little more, if it hits all-time lows, I kind of want to do that.
Yeah,
I'll
if that's, I would do
keep
it
that
too.
as a prerequisite.
Considering what we saw on Friday, where the Nasdaq was down, where did it close? 255%, and we're talking on my watch list. Everything finished green, basically. I mean, that's
Go-to's
something
down to like
insane.
1.5, and I'm kind of I want that.
Yeah, think about it. I mean, the only ones that finished red are the two that are doing what? Share buybacks. KC and GoTo. They're the only ones that were red. Oh no, GoTo was green. It was up 4%. KC was red though. I mean, they have share buybacks. I mean, this shit's gonna be ridiculous. They're buying back.
Doesn't it
shares.
end in May? Or does it start in May?
What?
Oh,
What was
sorry.
that?
Doesn't it end in May or doesn't it start in May? The buybacks.
For GoTo, it ends in May. For KC, we don't know yet. It's probably gonna last until like June, July, something like that.
September,
Maybe
October?
towards later in the year.
Okay.
But the point is, it's going to add buying pressure to the stock. And they said straight up in their interview with the shareholder meeting that they're doing it to increase the value of their stock. I'm like, all right.
Yeah, I do remember GoTo saying they would do it up to 10 million, but that doesn't mean 10 million, right? It could only just.
He already has 80 million shares of the company. He owns like half the float. They're about done with this shit.
Hey, RC,
So
what do you think?
He's like RC on steroids.
He's in here.
When do they flip the switch?
Bro, don't worry, bro. We
When?
won't tell anybody. It's like that. It's like in Space Jam, where like fucking Bugs Bunny comes in, like the kids. We won't tell, bro. Just do the thing.
Hey, what you guys thinking about Xerox?
Charlie, what kind of movement do you anticipate?
For what?
For China, like the actual behavior of it. I'm not saying any
That's
target.
what's kind of uncertain. I think that we're going to see steady rises, but I don't think. I mean, we may see a crazy beginning. Yeah, I mean, I think a stair step would be ideal, but there's no telling because you got on one side. I mean, they're China and the U.S. are both doing liquidity injections in a minute on both sides, and if they're dual listed, I mean, holy shit. So it's hard to tell, and the fact that their economies are opening up potentially, and all these lockdown narratives are out there, but I think they just magically open up here soon. Fucking
what I'm questioning is just last time they do liquidity injections, we felt that shit. It was strong, but they're also pressed for time, right? They're delayed. They're way behind schedule. So are they gonna like do a big rip first, or I'm not even sure what they'll do.
That's what I don't know. I mean, that's what's hard to tell. I just like you just gotta be ready for that shit either way.
I think like what would be ideal for them is just to do that big rip early on.
Yeah,
so that
lure in retail and get them to think it's still going to go to the moon, and then that's when we sell our fucking shares and make call. You know what I mean? That's when we sell our calls and shit.
Sell calls on this shit, right? And then just IV crush.
Yeah, exactly. The first wave, I anticipate, a little bit of consolidation because I mean, think about it. It's got to go up and retrace so much. It's going to have to sit there and test for a minute, and that's when they're going to sell calls. And that's when we're going to sell calls too, and that's the plan the whole time. And we hold our fucking leaps, until 2024, and those just gain and gain over time. And it's a perfect setup.
This is why I leveraged up because I'm thinking, all right, it drops like a rock. They're gonna spike this thing to like double, and then
until now, I think you did perfectly. Like now's
Well,
the time.
I'm leveled up to like ×2. I can go to ×5. I can still keep going.
Oh my god. I don't
I'm
know,
waiting
man.
for this, but I don't know. It
Like,
just
I would love to
if
make
I
a
do
fucking
this,
millionaire out of this group. That'd be badass, but that would
uh,
suck if it didn't happen the right way. Anything can happen. That's the shit. You know, theoretically, the SFT on paper won't be ready until May, in the middle of May. But I mean,
well,
you're
okay.
talking like
I
data doesn't
suppose the
even
best
factor
question
that.
for this is, will it go down still from here? Because that's the risk. If
I
it
don't
goes any
think.
worse
I
than
don't
this,
think.
oh, I don't know.
I
I'm
think
fucked.
it's consolidating. I don't think it's going to go down much more. I mean,
All right,
it
I think I
may
can
be
play
to finish
this.
off the rest of that gap, at which point I'll fucking double down again on this motherfucker. But if it doesn't, I mean, I think we're going to see more sideways than anything. But if anything, I mean, it's got to go up. I mean, it's these things are cooked. And then obviously what happened the other day was a false start.
Yeah.
And,
I'm thinking I'm gonna hold on to this and see what happens next week first.
Well, yes, I mean,
If we
you don't
get
even got to
IV
wait on
crushed,
data
I
for
might have to
what,
consider it.
35 days. So if you're in the money and you're that far out, you won't even really feel it until we're talking like another month and a half maybe.
Yeah, but if it drops again, oh god, that's gonna
I just don't
hurt.
see how they could do it. I mean, we're talking record FTDs. Yeah, the IV is fucking high for this expiration and next expiration, but it's really theoretically it's really not high for the stock's history. Because remember, IV's relative to the stock, so the delta it's super low for May. On the $5, it's saying it's only thinks the market only thinks it's gonna be 23% chance that it closes at $5. But even if it goes up to 4.8, that's a massive percentage swing from KC.
Yeah, it's like what 70-60%,
something like that.
Hey
About
Charlie, would
40,
you
I think
say
about 45, something like that.
would you say that the reverse repo like dropping below $1 trillion be kind of a signal for this next ADR and the Chinese stuff to start doing some bigger
Yeah,
movements?
I mean, if you look at it, I mean, it's weird because every time that the repo drops, like we saw a drop on Friday, right? It was like I think almost 100 billion or so, and they clearly saved that shit for the end of the day because that's what the SPY shit itself. You know, I think that they're going to go up as the repo goes down, and it's going to kind of be like a mirrored effect. It just depends on.
So crazy.
Yeah, because you saw
Hey,
the
Charlie.
opposite happen. They were loading it up, right? China went down while the repo went up.
Yeah.
So that's just nuts.
There's something you mentioned, like I think last week or the week before. It was so our core logic works really well during a illiquid market, and then you mentioned something else working for a very liquid market. Do you remember that?
Yeah, that would be the ADRs are for liquid markets. They're the most liquid thing you can get your hands on in the market.
Okay, but as far as like replacing our core logic with whatever works, sorry, it's a blender in my background.
Oh, I don't actually remember what I said exactly.
Mm.
Was it because right now the only three that I have on the top of my head is the metaverse and core stuff, and then the China stuff.
Hey, Charlie,
But the
you're saying
point.
that if oh, go ahead. I didn't
No,
know
you're
you.
good. Go ahead. No, you're good.
Yeah, I was gonna say if the market's gonna be trading sideways, right, and it won't be as volatile, right? Can't we just play off the MACD then? Just play the bananas?
Yeah.
If
That's
it's
what I'm
not that,
thinking, right? Just cycle it. Yeah. Then that's what I was saying. Like people
That's what it was.
that are
Yeah.
more. We have a lot of badass people in this group that can trade off of that kind of stuff, and that they kind of guide us through those times if it comes to that. You know what I mean? Like there's a lot of people here that are fucking really good with pattern recognition and TA and all that shit. So
Like Ryan Cohen, or
yeah,
Big Daddy, or was it Dick Ball 69?
yeah, dude. Well, Crypto Kid, or someone was like, dude, this guy's Ryan Cohen, and then like 2 seconds later, Ryan Cohen tweets, he's just like, hola. I'm like, what the fuck?
Dude, that was me, and I totally think Dick Ball 69 is Ryan Cohen.
Dude, that'd be nuts. Yeah, and then that one day, like Ryan Cohen tweets, and then Dick Balls comes in all of a sudden. He's like, "Hey, did you see the news?" And then like he stops replying all of a sudden, and then Ryan Cohen tweets again, and then he comes back. He's like, "Hey, I'm back."
Yeah,
that was yeah. It's all good though. That'd be funny if like they like since we're LLC, they just like buy FUDSTOP, and we're like, "Hey, we're a subsidiary of GameStop now. Time to go to Twitter." I'd start pushing DRS. Just kidding.
Okay.
Nah.
All right, guys. Well, I'm out.
Yeah, me too. But yeah, we'll see what happens.
Cool.
I wouldn't
Good night,
leverage up too much because you never. I mean, the summer is like the can kick fucking zone, bro. You gotta be careful. I just don't see how they can kick it any longer.
Charlie,
Those
one
people
last
in
question.
China get pissed off that are locked up in their houses for no reason.
Charlie, one last question. I know, like you said, so behavior more like stair stepping, maybe tracement, consolidation, and all those scenarios. It's more of like how you play the options and hold on to the shares like more of a long term, maybe like a year or two, depending on what happens.
Yeah, see, in my situation, that's why I don't give a fuck because I'm holding 2024 contracts and I can just sell calls with my shares and just fucking just chill while it's consolidating.
Cool.
Basically, while it's taking a breath, that's when I sell calls, and while it let the other retail that didn't do the research FOMO in and not realize it's about to just keep trading sideways. You get a call, and you get a call, and you get a call. Because yeah, I mean with this IV now, I mean, dude, I mean if it runs again, we're talking. Did you see how much the IV ran last time? It went up to like 800%. Like, yes, please. That's why I'm saying like I'm been stacking up as many fucking shares as I can possibly get of these motherfuckers because I want to sell as many calls to these fuckers that didn't believe this shit was gonna happen, and then they try to FOMO in at the wrong time. You know that's gonna happen. All right, well, take it easy.
Charlie, thank you.
Yeah, y'all have a good one.
You too.